Time for Hot Picks. Our guest has been looking around for opportunities in smaller and mid-cap equities that could be unaffected by tariffs. We're joined by Julien Nono-Womdim, VP of Equity Analysis at Goodreid Investment Counsel. Thank you very much indeed for joining us.
Thanks for having me.
A fascinating thesis here. Let's start off with Mastech. It's a big infrastructure construction company, very involved in communications infrastructure. You think that its business means that it's relatively immune to tariff harm?
Absolutely. If we take a step back, I think it's important to recognize that where we are today, there are a couple of headwinds. The first one being tariffs, and that has yet to be resolved. The second one is the geopolitical situation, whether in Europe with Russia, Ukraine, or in the Middle East. And the interaction of all these variables is making investors wonder if the U.S. is going to enter a recession. Within small caps and mid caps that are exposed to the U.S., there are a lot of opportunities. On Mastech specifically, if we go back to 2022, the Biden administration signed in the IRA, the Inflation Reduction Act, and that was a big push towards infrastructure spending domestically. That investment in infrastructure spending has continued. In fact, we've seen the Trump administration with Secretary Bessent say that the U.S. consumes too much. They need to build and manufacture more. Well, all that needs a lot of infrastructure. Mastech, we like it because it's well diversified across communications, so they benefit from AI, power, more transmission and distribution lines, not just to support AI, but also to support electric vehicles at home. And of course, energy, both clean and conventional sources of energy.
And also, you may have mentioned this, communications, including 5G and fiber.
Absolutely, yes.
Okay, your next idea is Clean Harbors. It's a big manager, among other things, of hazardous waste.
Correct. I think most of us in the public markets are familiar with the larger waste management companies. What we like about Clean Harbors is that they focus on industrial waste. And then going back to this idea that the U.S. needs to manufacture more domestically, it means industrial activity on a sustained basis is likely going to increase. And I think our thesis is predicated on 3 points. The first, as I talked about, is the re-architecting of the U.S. economy. The second one is on regulatory capture. And the last one is on the industry structure. On the regulatory side, building new incinerator capacity is difficult for environmental reasons. Clean Harbors has a strong market position. Building new industrial landfills, again, also regulatorily challenging, and therefore incumbents have a meaningful competitive advantage. And lastly, on the industry structure, over the last 20 years or so, we've seen significant consolidation in the waste industry, and consequently, as industrial activity and onshoring and reshoring manifests itself, we should see sustained pricing tailwinds and, of course, revenue growth for Clean Harbors. And that will allow them to grow earnings and, of course, redeploy capital into smaller acquisitions as they've done in the past.
Does Clean Harbors deal with regular residential and industrial garbage as well?
They're mostly known for their commercial and industrial activities.
Right, and that's interesting. Yeah, good luck getting a hazardous waste incinerator built these days. Who wants that near them?
Absolutely, absolutely. And you have to keep in mind there's a housing shortage in the U.S., and so land is scarce. So all these from an environmental perspective, there are concerns in terms of adding landfill capacity. That's number one. But number two, the value of idle land is actually high. So incumbents in the waste management space have a significant competitive advantage in that regard.
Now, your final idea is Leonardo DRS, and it's a subsidiary of the Italian armaments maker Leonardo.
Correct. And going back to this idea that tariffs, geopolitics, may mean a recession, the reality is, given that the threat environment globally is elevated, defense companies are likely going to be unaffected by a potential recession in the U.S., number one. Number two, given that NATO and Europe, generally speaking, has to spend more on defense, we could see an environment where spending for them improves meaningfully. Specifically, why do we like DRS? Well, DRS is an American-based subsidiary of the European defense company Leonardo. And effectively, the company combines the best of US technology, the best of European technology, and also the best of Israeli technology through a merger. What I'd say is there is a need to modernize defense equipment. The war in Russia and Ukraine has demonstrated that the battles of today are very different from the past, and Leonardo has a leadership in various radar systems, various situational awareness systems. And secondly, they have a lot of sole proprietorship in terms of component supplier for various departments of defense projects. And so their position should support sustained growth. The threat environment in the short term is, of course, negative for us, but it benefits the company.
Those defense stocks have had such a run up, though. Are you worried that there could be just too much optimism in them right now?
I think you make a strong point. Leonardo DRS trades at sort of 35 times forward estimates, which is considered expensive. There is a recognition by the marketplace that the threat environment is elevated. The earnings from these companies have been strong, and consequently, they're being rewarded with a high multiple. Whenever you have a stock with a multiple that high, effectively the market is saying we are very sure that the future for these companies is going to be bright. In this case, I think that the data we've seen coming out of Europe in terms of increasing defense spending on a sustained basis is supportive of that view. Secondly, there's a modernization effort, as I mentioned earlier, not just in Europe, but also in the US as well, given the changing dynamics of modern warfare. And so I think the valuation is justified. It's not trading anywhere near Palantir multiples, that's for sure.
Thank you, Julien. Julien Nono-Womdim has been our guest. He's VP of Equity Analysis at Goodreid Investment Counsel. Thank you very much indeed for watching The Open. Morning Markets is up next.